So let's start off with an easy or hard question, depending on how you want to look at it. Is it enough?
No, I think it's a relatively easy question. It isn't. The demand declines are far, far severe. You could be looking at 20 million barrels per day of demand decline drops in April. And if some of these measures continue through May, demand will remain very depressed through May as well. And remember, the headline number might be 9.7. Actual cuts will end up being more around like 7 million barrels per day. Some of the compliance numbers required from countries such as Iraq and Nigeria, they're just not feasible unless and until the market forces it on them by just running out of storage.
All right, so that means that the actual output cut won't be as forceful as the headline number. What exactly are we cutting from? What benchmark level are we using to say, hey, here's the 9.7 million barrels or the effective 7 or 8 million barrels that you're speaking of?
I mean, this is it's Olympic math if you kind of come to OPEC numbers. The baseline that the group has used for OPEC plus cuts is October 2018. Remember, that's when pretty much all producers had surged production. This is when Trump had said he wouldn't be giving waivers to Iran. But, of course, Saudi Arabia and Russia took an even higher number than October 2018. Both of them have agreed to 11 million barrels per day as the baseline. However, in April, we all know that after the OPEC Plus deal fell apart in early March, the GCC countries surged production to even higher than those levels. Saudi production was, they claim close to 12.5 million barrels per day. So the real cuts for the GCC countries are bigger than the 23% implied by the kind of table that they've published. But for all the other countries, it's actually lower because the October 2018 number baseline is actually inflated.
All right, so Amrita, we're showing viewers right now, and I'm not sure you can see this, but we're showing viewers prices for WTI crude and for Brent crude. WTI currently trading a little below $23 per barrel in the futures market. World benchmark Brent $31 per barrel or thereabouts. As we've seen these prices come into play over the last week or so, how much, I guess, economic activity is priced in? With the oil market at these levels right now, are we pricing in that things get resolved a little bit more? Things start opening up by, say, June, July, August? Is that how the oil market is reading things right now?
I would say so, because the curve is in contango, which essentially means the front month prices are the lowest and then subsequently the prices are going higher. And the contango is very steep. So WTI, the second month already is $6 higher than the front month. And I think that is kind of saying that we will slowly start to normalize after June.
All right, so if we are going to slowly normalize after June, what exactly is the outlook then for many of these oil-producing countries? I want to talk specifically about what the outlook is for U.S. shale producers, because they seem like the ones that could be the hardest hit. They have some of the higher relative costs of extraction and production. What exactly does that mean for the U.S. shale business?
See, when I say that we're going to start to normalize, I'm talking about demand. But we are going to be building record amount of inventories in the next few weeks and months. That's going to take months, if not years, to run down. When I speak to physical players, they're telling me they're putting crude in places they didn't even know existed. That's the problem. So even though demand starts to slowly recover, we will have such a big overhang that prices will remain very much at around these levels, maybe even slightly lower or a touch higher for the bulk of this year, if not for a good part of at least the first half of next year as well. And that's the issue for U.S. shale. Like you say, it's higher cost. We can't see how U.S. shale recovers very quickly from this. Production declines are going to be immense.